80% of day traders lose money, but long-term investors, they win big. So what's the difference? If you're new to investing, you don't need luck, you need a strategy. Welcome back to Simply Money. Investing doesn't have to be risky or complicated, you just need the right approach. Today, we're breaking down 3 beginner-friendly strategies that actually work. See, for most beginners, fear of losing money or feel overwhelmed by endless investing advice. And some of the common mistakes that they make are 1, trying to time the market instead of just staying consistent. That is the biggest danger, and I see it over and over again. I get comments in my videos all the time about people asking about the up and coming or the latest stock or ETF they just heard about, and they're wanting to try to time it and to get in just at the right time. But the best method is to just stay consistent and to buy on a regular basis. Another common mistake is putting all their money into one stock instead of diversifying, thinking that if they put all their money into this one big thing, it'll make them millions and millions of dollars. But for every success that we read about, for every big company that we see that's made it, there's hundreds that have not. And those people that put all their money into those small companies that didn't make it, hoping they'd become the next big company, lose their investment. So you want to be diversified. A third mistake is not starting at all. Their fear and lack of knowledge hinder them and prevent them from making a decision and investing at all. Staying on the sidelines out of fear keeps people from reaching their financial goals. But the good news is you don't need to be an expert to invest wisely. Let's look at the 3 strategies that can work out for the beginner just to get started and to have a strategic plan to help build wealth in a safe manner. Number 1 is to dollar cost average. So instead of dumping money in all at once, invest a fixed amount on a regular basis. Maybe it's $50 a week. A lot of people want to save up until they have $500, $1,000, $10,000, and they're going to buy one big payment into the stock market. And that may work out. Maybe perhaps when you make that investment, you got it on a dip, but perhaps you bought it when it was at a high and then it drops. Dollar cost averaging helps protect against that volatility, reducing risk over time. There'll be times when you're buying when it's a little high. There'll be times when you're buying it a little bit low, but it averages out and it helps hedge against that volatility. Dollar cost averaging is an important strategy, especially for beginners. Number 2 strategy is index fund investing or ETFs. Why try to beat the market when you can own it? Investing in an S&P 500 or total market index fund is a proven way to grow wealth with minimal effort. And 84% of all managed funds don't perform as well as an index fund because even the most well-trained financial advisors have an emotional element where an index automatically adjusts and makes the decisions and keeps those high earners in and drops off the low earners. And so that protects you. And an index fund is a great way to keep your balance and to build your wealth. If you don't understand index funds, ETFs, check out the channel. Just type in index funds and you'll see some videos that come up and we break down what are index funds, what are ETFs, what are mutual funds, and understanding how those work and some of the nuances of those to better prepare you. And strategy number 3, especially for beginners, is diversification. Don't put all your eggs in one basket. Spread investments across stocks, bonds, real estate, different sectors. Even in a good ETF, you want to make sure that ETF is diversified. Some ETFs are highly concentrated in 1 or 2 sectors. And if that sector is going through a really tough time, all your money is in 1 or 2 sectors. I use as an example, SOXX. It's a great ETF, but it's all technology. You don't want to be in that type of investment because if technology is down, all of your money is down. Or if you're in something like the S&P 500, it's more diversified and has exposure to utilities, finances, consumer goods. And so you're spreading out and being diversified, and it helps balance when one sector's up, maybe another one's down, and it helps the volatility. The secret is simply consistency and patience, not luck or timing. The stock market is not a gamble. It is a strategic plan to invest for the long term. But people get scared and they lose their strategy and they bail early. If your plan is to retire in 20 years, you don't have to worry about what's happening in the next 1 or 2 or 3 or 4 or 5 years, because you have 15 more years, 25 more years to ride out those storms. There's going to be downturns. The market on average once a year will correct 10 to 19%. Means you're going to watch your money drop 10 to 19% almost on average once a year. And there'll be a bear market almost once a decade, if not more. And that's when the market drops 20% or more. So you're going to have to be prepared to watch that. But that's where you can't lose your strategy and stay committed to the long term, because those always return and they go higher. And that's the whole point. You're investing for the long term. So quick recap. DCA, dollar cost average, invest small, invest often. Index funds, passive, stress-free growth. Diversification, spread risk, build wealth. See, investing isn't just for the rich. It's for anyone willing to start. Don't let fear keep you from making investments. Do your homework, do some due diligence, understand some of the basic concepts of what you're doing, but get involved, because just saving your money isn't going to be enough to beat inflation and you're losing purchasing power. Invest and grow your wealth. What do you think of this video? Hit that like and subscribe button. And which strategy did you like best? Leave a comment down below. Don't forget to hit that bell so you're notified of future videos, and we'll see you next time on Simply Money.